Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello trading cats, I'm the risk manager at the Forex Super Model, and this is part 2 of an economics video aimed at traders, and this is the importance of injections and leakages from the circular flow of income. Now, if you remember the first part, hopefully you've watched it, the circular flow of income is this circular flow between income, expenditure and output. Now, then we're talking about leakages and injections. So we've got this, economists like to think of the economy as some sort of tank, if you like, and if you have a leak from the tank, the economy gets smaller, and if you have an injection, in other words, somebody, if you think of it as a bath maybe, somebody turns the tap on and fills the level up, and that would be a sort of a rough version of GDP rising or falling as we go. So now the problem with economics, as we've said, is it's full of jargon, and it's full of jargon which unless you're sort of fairly with it is interchangeable, and some economists are relatively lazy and use slightly different terms for the same thing. So it's a good job I'm here to sort it out. Anyway, right, so the importance of leakages and injections then. Right, so if you remember, via the expenditure method, and there's 3 methods of calculating GDP, expenditure, income and output. This is via the expenditure method then. GDP at market prices, if you remember, equals C plus I plus G plus X minus M, where C is consumption, I is investment, G is government spending, and X minus M is X is exports minus imports. So that's a net effect of external trade, balance of payments, if you like. Now that C plus I plus G plus X minus M is GDP at market prices, but it's also known in the trade, in economics, as AD, aggregate demand. So aggregate demand equals C plus I, etc. And they also call it aggregate monetary demand. So AMD, aggregate, if I could say it, aggregate monetary demand. So that's C plus I. Right, so once you get over the hump on that, you'll see that in various publications and textbooks, and it's all basically the same but different. So, right, injections then. So what are the injections into the circular flow of income? Now, injections then, we designate J in economics. Why? Because I is used for investment. So J for some reason is an injection. Anyway, doesn't matter, that's what it is. Right, so injections then, they're things like, so investment is an injection, so called. Government spending is an injection, and exports are an injection into the circular flow, into our economy, if you like. So, and this is in addition to C, in addition to consumption. Right, leakages then, or also known confusingly as withdrawals, and then they're designated W, which probably makes more sense to calling them withdrawals, but I like to call them leakages. So injections and leakages. So they're things flowing out of the circular flow, and the first one here, see, I've rubbed this off again, I'll put it back there because it's not too much. Right, so leakages or withdrawals, designated as W, are things like savings. Now we'll talk about that in a minute. Taxation, T for taxes, and M for imports. So they're things that are flowing out, but there's a caveat to that which we'll talk about in a minute. And these injections are things that are flowing in. So investment, government spending and exports in savings, taxes and investment, government spending and exports in savings, taxes and imports out, in theory. So that's where we are there. Just going to shut this down, so don't go away. Welcome back. Right, so we've talked about the circular flow of income, and we've talked about injections and leakages from an economics perspective. But from a trading perspective, we can broaden it out a little bit. Right, so an injection is something which increases the level of aggregate demand, in theory, and a leakage or withdrawal is something which reduces the level of aggregate demand. Now, we designated certain things injections and leakages, but obviously there's two sides to this. So when you're thinking in terms of data coming out in the economic calendar or any form of analysis, if you look at consumption, for example, a rise in consumption then means that households are going out and spending more on goods and services, and that tends to be that's clearly an injection into the economy. That's going to boost up GDP. And likewise, a fall in consumption is going to be a leakage, and that's going to reduce GDP. So that's relatively straightforward. And real world applications of this are, for example, in Japan, they've had like years of deflation. And deflation is basically the opposite of inflation. It's a persistent fall in the general price level as measured by an index, for example, like the CPI or something like that. So why did the Japanese reduce their consumption in a deflationary period? Well, probably numerous reasons, but one of the reasons was that if they knew in 3 months' time they were in a deflationary period, then goods were progressively becoming slightly cheaper over time. So there was no incentive to rush out and make purchases, because if you waited a little bit longer, you ended up with the same goods slightly cheaper. Now, the problem with this is it engenders some sort of frame of mind and expectations that prices will be cheaper tomorrow. So there's a putting off or abstention of consumption, which means that their economy really languished for a long while, and arguably still is, because it's not been fired by this consumption element, which is very, very important for a lot of Western economies. Represents quite often 60 to 70% of gross domestic product, GDP. Anyway, so that's consumption. That's an obvious one. Investment then, likewise, is a relatively obvious one. If you get a rise in investment, that means that firms are purchasing investment goods, capital goods, things like machines, factories, and that will generate higher GDP. Likewise, if there's a reduction in investment, that will equally reduce GDP. So they're fairly straightforward. Now, government spending. Now, you've got to remember that what does the government do? It drags in revenue from taxation and then very nicely gives it us back, government spending. So if the government increases government spending, it's a two-edged sword. But let's assume that the government increases government spending and it goes on things like construction in the economy, roads, railways, things like that. That clearly is going to have an effect on increasing GDP, because those expenditures provide incomes for construction companies and workers, and it feeds through the circular flow. Anyway, so that's all relatively obvious then. So a reduction in government spending likewise has a negative effect on GDP. Then we move on to exports. Right, well, so if we get a rise in exports, so we're exporting more to other countries abroad, then we're sort of it's an expansion for us, if you like. We're exporting some of our goods and services, and in theory we've sort of got an export-led growth, and this leads to a rise in GDP as well. So, but if you get a fall in exports, likewise you get a reduction in GDP normally. So in simplistic terms, I must add. Right, so imports are the opposite then. So if you get a rise in imports, so if we start sucking in imports, that is normally viewed in economics as detrimental to domestic GDP, because we're providing income to other countries in the same way that they're providing income for us when we export more. So a rise in imports is not a good thing as far as GDP, whereas a fall in imports arguably is. But it's more complicated than that, but that's just the initial way of looking at it. Right, then we move on to savings. Now, we haven't really talked so much about savings. Now, when you have an income, so you have two possible things you can do with it. You can either use it for expenditure, you can consume the income, or you can abstain from expenditure and you can save it. So, and the proportion, economists are very interested in the proportion of consumption relative to savings. And so this comes into this savings ratio or consumption ratios, which we can talk about further. And you end up with a consumption function, which is how much of someone's income is consumed relative to their income, and how much is saved relative to their income. A savings function, if you like. So if you get a rise in savings, it means that by definition consumption relatively is falling. So that would be a leakage. And if you get a fall in savings, that's relatively an increase in consumption, and therefore that's an increase in GDP. Right, taxation then. Remember, taxes are of generally two types. They're direct at source, so that's like income tax. You go to work, you get your paycheck, and you look on the dotted line, it says you have paid X amount in deductions, which are at source. Income tax. Direct taxes. Indirect taxes, you get your money, you think, whoopee, I'm off out to spend some stuff, and that's discretionary expenditure, which is basically they get you there on the taxes in terms of value added tax, VAT. So indirect taxes are discretionary, direct taxes are at source, effectively. Right, so a rise in taxation, so the more money is taken from your potential consumption is actually a withdrawal leakage from the system. And if taxes go down, do they ever go down? But if they were to go down, then that would be viewed as an injection into the circular flow. So, and if you remember, we've got different sectors of the economy. If you look at the model of the economy in terms of a two-sector economy, you've got houses and firms, households and firms, C plus I. Then you've got the government sector for a three-tier economy, G, and then for the four-sector economy, you've got exports minus imports. You've got an external element to it, international trade. So that's basically what we're looking at here. That you won't go too far wrong assessing economic data as it comes out relating to these components in that method. So, for example, if you get if retail sales are very strong, come out for whatever period, then that would be an injection. So that's likely to be bullish or an injection and so forth. So and if the trade balance is strong, then a positive trade balance means we're exporting more than we're importing, and arguably that is strong as well, and vice versa. So that's where we are there. So we're going to stop it and then we'll move on in a minute. Right, welcome back, cats. Now, if we continue here. Now, in economics, a major part of economics is concerned with Keynesian theory. Who was Keynes? Keynes, his full name was John Maynard. He was an economist around in the 1920s and 30s. So we're talking 100 years ago now. Cambridge man in the UK. Governments used to use him to analyse and tell them what to do on the economy. Basically a super brain box who pushed economics massively forward in a certain direction, Keynesian theory. Now, so the Keynesian consumption function, right, and a function. So what is a mathematical function? Well, it's, in this case, it's the consumption function. So it's relating to consumption. Remember what consumption is. It's expenditure on goods and services in the economy, important for a big component of GDP. The consumption function then, consumption is a function of Y, income. So remember, I is not used for income in economics, it's for investment. So and if we write it out as a function, mathematical function, I know, don't go to sleep, we won't be dwelling on this, right? So consumption equals A plus BY. Now A in this case is what's known as autonomous consumption. Now this is another economic term, autonomous. Now what does autonomous means? It means it's independent of something. So in this case, consumption, an element of consumption is independent of income. So for example, so that's your minimum needs. No matter how low your income, you have to survive. You have to eat a certain amount, drink a certain amount, all the rest of it. And that, in the theory, is known as autonomous consumption. So autonomous consumption is like, it's not related to your income. You do this anyway because you want to survive. It's the minimum level of consumption. So and that's where the sort of the term automaton comes from. And it tends to be linked with robotics. If you call someone an automaton and then duck in case they punch you, then basically you're calling them a sort of a mindless person that has no attention to the outside world and is just following a set pattern of rules and on a decision-making basis. So they're like a robotic person. Anyway, but of course we won't do that because we're not nasty people. But anyway, autonomous consumption then is this element. And then the rest of your consumption is linked to your income. So obviously, if you think about it, the higher your income, normally you change your consumption pattern. If you get a better job, you might buy a better house, flash a car, whatever, more expensive shoes. It doesn't really matter what it is. So a component of your consumption is autonomous, which means it doesn't change with your income, and the rest of your consumption is a function of your income. Now the B part represents the sort of it's almost like a second derivative type. So it's the rate of change. So it's the change of consumption relative to the change of income. Now this is very important in economics and for trading in a way, because when you plot out a consumption function, which is if you draw it as a line like here, so this is your consumption function, and it doesn't start at zero because we know we've got this autonomous level of consumption. Even if our income is zero, we still consume. We find a way. We borrow, whatever. Right. So our consumption function doesn't start from zero. It starts from whatever our autonomous level of consumption might be, and then given as income increases going this way, then our consumption increases. And it increases as a proportion of income, and this proportion can be measured by what's known as the change in consumption over the change in income, which basically is what's known in the trade or economics as the marginal propensity to consume, MPC. So the MPC, the marginal propensity to consume, shows you in simple terms how much of, if you get an extra, say, pound or dollar of income, how much of that extra income you consume and how much you save. So that has, and if you look at the diagram here, we've drawn in this 45-degree line, which is where consumption equals income, because at all these points your consumption will be identical to your income. Now that's an important point as well, because that means along this line you're consuming all your income, your savings are zero. Now here, at this point here, this is the point where we actually are able to sustain ourselves from our income. So here our consumption is here, but our income is lower. Now, therefore, we're dis-saving, if you like. We're dis-saving up to this point, and beyond this point, we've got a surplus of income for our consumption, and we can make some savings. Right. So the reason we talk about the consumption function and the marginal propensity to consume is because it has implications for policy. For example, so if the government, basically the poorer you are in simple terms, the higher normally your marginal propensity to consume. If you give a relatively poor person an extra £1, they'll probably go out and spend it. If you give a very wealthy person an extra £1, they'll probably save it. So the further you go up the income tree, the relatively lower your marginal propensity to consume is. So you may be consuming more in real terms. You may have a private jet and a yacht in the harbour, so you're consuming more. But in terms of a marginal propensity to consume, your margin of every extra £1 you get, you consume less. So the person who's just beyond the park bench will have a very, very high marginal propensity to consume, because every extra £1 or dollar they get in, they will need to kit themselves up with the accoutrements of life: clothes, entertainment, whatever, housing. So that has implications, and it has implications for the government, not only in consumption but in taxation. If you tax the wealthy at the same rate as the poor, and bear in mind there's more poor than wealthy, relatively speaking, then you'll get a different net effect, and that's important. So if you want to stimulate the economy, you want to give the lower earners a boost rather than the higher earners, and this can fly in the face of certain previous policies. But if you give extra money to lower income families and people, they will likely go out and spend it, and that expenditure will form consumption, which will be an injection into the circular flow, and Bob's your uncle, the economy rises, GDP, etc. Now, we'll stop it there and just finish off in a minute. Right, we're off again. Welcome back. Now, to summarise then, what have we said? Well, we've said that the circular flow of income is important when you're looking at GDP, gross domestic product, and the components of aggregate monetary demand or aggregate demand or GDP at market prices, whatever you want to call it, C plus I plus G plus X minus M, can be viewed as leakages or injections into the circular flow, and they have a positive or negative effect on GDP. You've also got savings and taxation in there as well. So you remember that we said, a rise in consumption was an injection. So you can break those down into whether, in theory, they're going to be positive or negative towards GDP. So when you're looking at the economic calendar or economic data, and you're seeing changes in these components, you can think to yourself, yes, that's going to have a positive effect, or that's going to have a negative effect, or the trend is improving, or the trend is declining, etc. Interesting. Right. Now, the other point we made was that the consumption function, that consumption is a function of income generally, but there's also an autonomous level of consumption, and that basically, whilst the wealthier you are, the more consumption you do, as a proportion of your income, is relatively less than the poorer people. So this has tremendous implications for policy in terms of taxation and consumption and savings. Right, now the final thing we need to mention here is that when you give somebody an injection into the economy, let's suppose we have a change in government spending, and we have a rise in government spending of, say, 100 million or whatever. We don't just get 100 million increase, we get it via a multiplier. and we get this Keynesian multiplier. Now, in simple terms, the Keynesian multiplier is 1 over the marginal rate of leakage. Now, that doesn't sound very simple, I know. Marginal rate of leakage. And 1 over is the reciprocal in math, but it doesn't really matter. All you need to understand is that let's suppose that people consume 0.88 of their income. So their consumption is 0.8 or 80%. 80% of their income. So every extra pound or dollar they get, they consume 80 pence or 80 cents of it. That means they save 0.2 or 20 cents, 20%, right? So basically, if you give people an extra pound or dollar, they will spend 80 pence or cents of it, and they will save 20 cents of it. So 0.2 or 20% leaks from the system. So, and that is part of the marginal rate of leakage. So in this case, our multiplier will be 1 over 0.2. So it's going to be, which equals 5. So our multiplier is 5 times the initial injection. And it also works the other way. So if you had a leakage, it would be 5 times the marginal rate of leakage. So you can see that potentially, if the government injects 100 million into the circular flow, and we've got a suitable multiplier of 5, then we could get 500 million increase in GDP over a period of time. Now, how does that work? Well, if the government, say, invents in construction style events, as an example, doesn't have to be that, but then they'll tender for these jobs. Construction firms will win the bids. They'll buy materials. They'll take on workers. Those workers will then receive an income, and then they'll spend it in the circular flow. They'll spend it. They'll go out and do whatever they do. They'll buy petrol, beer, housing, whatever. And then those people that have sold them that will be their income, and so on and so forth. And so you get a series of rounds of expenditure which go round and round in the circular flow. But each time the round goes round, if you like, it's reduced, because the first round is like 0.8, 0.2, fair enough. And then the second round is the same figure, but it's 0.8 of 0.8, which is 0.64, and so on. So you get like a series of reducing rounds of expenditure as you go through, and that, if you do the maths, and we don't need to, and you've got a multiplier of 5, and you've got an injection of 100 million, you end up with 5 times the 100 million. Eventually, in theory, you end up with that. So that's important to know, and it also works in reverse, which isn't very nice sometimes as well. So anyway, so there you go. That's the summary, really. So it's a sort of carry-on video from part 1. Economic objectives. It ties in with the circular flow of income. We're looking at injections and leakages. We've looked at the consumption function and the relationship with income, and we've also brought into this idea of the Keynesian multiplier into the system. So hope that was useful. See you again for part 3. Thank you very much.